Welcome to Insight. I'm Charu in Seoul. The top stories this hour. South Korea's president speaks out. Yoon Yeol saying that he'll fight until the last minute to defend himself, accusing the opposition of trying to paralyze his administration.
Dear citizens, the opposition party is accusing me as a felon and is now trying to remove me from the presidency immediately. I will not give in to their demands.
Also coming up, Donald Trump reportedly reaching out to Xi Jinping even as he threatens tariffs, inviting China's leader to his inauguration next month. Asian stocks advancing after Wall Street snaps a two-day losing streak, with U.S. inflation numbers bolstering bets on a Fed rate cut next week. Plus, LaSalle Investment Management gives us their 2025 outlook for Asia-Pacific commercial real estate, with China's sluggish economy and potential BOJ rate hikes making it a complex environment. But to our top news, South Korea's President Yoon Yeol has spoken now publicly, saying that he will fight until the last minute to defend himself, and offering an explanation for his short-lived declaration of martial law.
I decided to invoke martial law, judging the current situation of the country's national affairs being paralyzed as a state of administrative and judicial collapse caused by social disturbance. But the purpose of the martial law was to warn the people of the opposition party's anti-state atrocities and to stop them. By doing so, I wanted to prevent the collapse of the constitutional order of liberal democracy and normalize state functions.
For more, Bloomberg Global Business reporter Hee-jin Kim joins us now here in Seoul. And Hee-jin, this is, of course, a developing story as we continue to learn new things happening around the president and in parliament as well. The latest coming from local media that the ruling party has named a new floor leader. We had seen some infighting within the PPP. What does this tell us?
Well, that is like a fight between pro-Yoon Suk-yeol and anti-Yoon Suk-yeol. I'm not sure if I call them pro-Yoon at the moment, but anyway, they say they are pro-Yoon Suk-yeol, previously at least. But so anyway, they are fighting with each other, like about how much they should protect Yoon Suk-yeol and whether they actually need to vote for the impeachment or not, because definitely Yoon Suk-yeol, made a lot of explanations about why he did do that. And this infighting in this ruling party actually indicates there is a rising possibility for this Saturday's vote. I mean, there could be, some votes against the impeachment, which means like the situation has changed.
To be fair, the country seems to be divided right now. We have seen pro-Yoon supporters in Gwanghwamun, for example, coming out in support of the president. But what is he saying right now that he says he was forced to actually declare martial law? He was sort of blaming it on the opposition, but also on North Korea.
Yes, that's true. He's actually saying that he's just sent small troops to the parliament, which means that he actually just trying to give a warning to the opposition party, because he really didn't like so much influence of the large opposition party, because the Democratic Party really trying to kick out some high-ranking officials, like the board of audit director or all other top prosecutors whom he appointed for him. But and also as you know, recently the opposition party also slashed a lot of national budget. He allocated for the economic growth. So he was quite angry about the influence of the opposition party. But the question is, I checked a lot of online comments on the internet just now, and then a lot of Koreans are criticizing Yoon because you cannot basically, send the troops just because you don't like the opposition party. So, yeah.
Even if it's a small number of troops, as he says. But what happens now? Because he's saying he doesn't seem like he's going to go away quietly. He says that he's going to fight until the end.
Yeah, right. That's why local newspapers saying that he's hiring some really powerful lawyers from big law firm, and he's going to definitely attend the hearing at the Constitutional Court, even if the vote is passed this Saturday for impeachment. He's going to, he's saying like a fight until the end. Implies a lot of activities he's planning. So we are hearing from our sources he's actually fighting, like preparing a big legal fight against the opposition party members.
Which is not going to be great when investors are watching and looking at South Korean markets. We've heard a lot from financial authorities as well.
Yes, right. We actually, during Yoon's speech, the Korean won is weakening further against the U.S. dollars. And we have a lot of concerns from the businessmen, analysts, fund managers there. They all want this situation is finished within this week.
Hee-jin Kim here with the latest as we continue to see the political developments here in Seoul, our Bloomberg Global Business reporter. Let's bring in Saxo's Chief Investment Officer, Charu Chanana, who joins us now from Singapore. Charu, great to have you with us. So what Hee-jin is telling us is that this could go on for months, and the president doesn't seem to be backing down. What does this mean for the markets here in Korea in the next few weeks?
Hi, Sherry. Thank you for having me back. Certainly, the Korean markets have had this huge discount to global markets, even the Asian peers, all through this year, because they have not been, been able to participate in that AI race compared to some of their closest neighbors, like the TSMCs of Taiwan, or even some Japanese stocks like Advantest, for example. Samsung, for instance, in Korea has not been able to give that kind of an AI momentum to its stock market. Now, club that with all the political issues that we are having right now, it does not seem like there's a close end to it, right? This has seemed to be a lingering issue. So as much as, we were hearing that Korea wants to kind of prioritize corporate reforms and bring some of those same measures that Japan has implemented to the Korean markets, that was looking like a good sign, but it seems like that would be put on a back burner and investors would be extremely cautious of the political instability that is likely to stay there right now.
What does that mean in the long term, though? Financial authorities here are saying that at least when it comes to 2025, all of the corporate reform programs that they've been pushing for will actually gain momentum because it seems that the opposition as well as the ruling party, despite their political differences, are on the same page on that.
Certainly that will become a necessity going into 2025, and I'm assuming by that time there will be a little bit more clarity on the political side as well, because that seems to be the first focus that Korean markets have right now. But along with corporate reforms, like I said, I think participating in that AI momentum is very, very important for any stock market to have a sustained rally at this point, because that is a structural theme that is driving the global markets, that is driving all the big tech stocks, and those are really taking the indices to the next level. Now, if going into the next year, we see potentially a slowing pace of, easing from the Fed as well, then we have the risk of tariffs as well. So I don't think the corporate reform momentum in Korea is strong enough to be able to counter those headwinds.
Even until now, there was a little bit of skepticism in South Korea's corporate reform, especially when it came to the Value Up program that the government has been promoting, especially relative to what Japanese authorities have been doing for the Japanese market. What were you seeing so far in terms of relative value and attractiveness of South Korea?
I totally agree with what you say there, Sherry. I think the measures from the Korean authorities have been a little bit more opaque, comparing them to the Japanese momentum, where we have seen some very clear measures that the companies need to raise the price to book value ratios to over 1. So I think that clarity is something that has traditionally been missing in the Korean announcements. So I do think, like I said, right, club that with all the other headwinds that they face right now, plus then they need to make their corporate reform momentum a lot more targeted to potentially some of the key sectors of the economy. They also need to focus on how the conglomerates really are driving the equity momentum there and how that can be a hindrance as well. So I think they have a lot of work to do right now.
Is the optimism about Japan's corporate reforms going to be enough to sort of support the market when central bank messaging right now seems to be a little bit mixed and traders seem confused?
Absolutely. I mean, I think those are two very important points you touch upon, Cherry. The central bank messaging is really, really mixed at this point, which is a signal, I would think, that they are not in a rush to hike rates right now, right? They want to wait. And when you talk about where the central banks are going from here, I think rather than just focusing on what is it going to look like in December, I think the very important aspect of this is to look at whether it is the right time to move in December or in January, because we know we have Trump taking office on the 20th of January, and both the Fed and the BOJ meetings are just a few days after that appointment date. So from a BOJ perspective, it might be the case that that appointment of Trump could bring in further weakness of the yen, and that's why they want to kind of preserve the ammunition now in December and be able to move in January. But when you talk about that corporate reform momentum in Japan and how that has boosted equity, certainly that has been a very strong story this year. But going forward, certainly these headwinds are coming their way as well, probably slowing global demand, and Japan being an export-driven economy. So I would say that the themes in Japan equities are getting a little bit more selective for me, corporate reform being one of the most important themes there. So, if I'm being selective, I would stick with that theme. Geopolitical tensions being one important theme as well. And as we see these diversification of supply chains, how Japan benefits from them by providing subsidies to chip makers, for example. That's something they've done in the past. I think that could be a positive theme for Japanese equities as well. But on a broader index level, certainly there's going to be some amount of volatility and headwinds coming their way as well.
What about the level of the Japanese yen? It's been pretty volatile, but does that also give a little bit more leeway for the BOJ not to have to act now? I mean, we're not in the 160s levels when the BOJ was getting pressure from politicians and households. But what does that really mean for the markets?
I mean, I see no reason why we can't get back to those levels in dollar yen, really, if this is the kind of communication we see from the Bank of Japan. And on the other hand, you have this US economy that continues to be strong and a Fed that still remains on track to cut rates despite the resilience in the US economy. They've had a little bit of a victory lap on the inflation front. So with this divergent theme, the Fed easing and the BOJ trying to hike but not really getting there, I don't see why dollar yen could not be even higher and then again become a pain point for the BOJ decisions. But at this point, like I said earlier, this is really about both for the Fed and from the BOJ. It's not just a December decision, but it's a December versus January decision, right? For the Fed, it might make sense to move early to be able to, pause at the January meeting and kind of really wait for those Trump policies to start being announced and start playing out as well. Whereas for the BOJ, they know just that the immediate appointment of Trump as well could bring a lot of headlines around tariffs and other inflationary policies as well for the US, and that would be a time where that weakness of the yen could exacerbate really, and that is the time they would need to react a little bit more firmly.
Charu, which takes me back to the first part of our conversation, because if you continue to see a weaker Japanese yen, how will its competitor, South Korea, that exports similar products, suffer? And what could that mean for exporters and for the broader markets in Korea?
So certainly the Japanese yen weakness has been one of the big stories driving the momentum in the equity market as well. Now we've seen, expectations of yen going both ways and going wild both ways, right? We've seen expectations going down for dollar yen to 140 as well, because we knew Fed is on an easing path and BOJ is on a path of normalization. Now the fact here is that I think what has been really driving the yen weakness was the carry trades. And even though the yen remains weak, even though the policy differential between the Fed and the BOJ remains wide, I think it's very difficult to put on new carry trades at this point because of the volatility and because of the expectation that eventually, of course, the Fed is going to ease a little bit more, get closer to, lower interest rates, and that will mean strengthening of the yen, which comes back to hurt Japanese equities. And that's why, again, going back to what I said earlier, earlier on an index level, given the momentum we've already seen and given that expectation that the yen will have to eventually rally, not because of what BOJ is doing, but because of what the Fed is doing, that will make me a little bit more cautious on an index level for Japanese equities, and that's why I'm being more selective there. But for Korea, certainly from an export perspective, that weaker Korean won can help. It can help in the sense that, of course, we need to see how targeted Trump's tariff measures are and whether they impact Taiwan and Korea in the same way or, in some different ways. So there's a lot of uncertainties going into 2025. But of course, for Korea, the first line of action has to be addressing this political uncertainty.
Charu Chanana, Chief Investment Strategist at Saxo. Do stick around. We're going to continue our conversation, but coming up, we'll get insight on how the real estate market across Asia could perform next year. LaSalle Investment Management joins us later this hour. This is Bloomberg. China's yuan seeing a little bit of support in trading today after weakness in the previous session. We had this report that authorities are considering a weaker currency in order to support exports. The renminbi has fallen about 4% this quarter as concerns mount over Trump's tariff threats. Yet yuan depreciation runs the risk of triggering capital outflows. Bloomberg's Avril Hong is here with a closer look. Avril, I mean, not a lot of people are surprised that Beijing might allow just the yuan to get weaker, but at the same time, that could come at a big cost.
Absolutely. There are risks to that strategy potentially. I mean, you look at how the currency has already weakened 4% this quarter as investors brace for tariffs. You mentioned these mounting speculation, the reports that Chinese authorities could consider greater tolerance for a weak currency next year. But you also have more recently pushback in a way from a PBOC-run paper warning against one-way bets and then via the fix. Today, we got support, 785 pips stronger than estimates, indeed, for the board, because I wanted to talk you through some of the risks as well from a depreciating currency, including capital outflows, spillover effects to other assets in China. And that's part of the reason, I think, why Robin Singh of Morgan Stanley thinks that versus 2018-2019, when we saw 12% weakening in the currency, this time around it might not be as severe. And this chart, courtesy of MLive's Mark Cranfield, also shows you how the yuan is nowhere near the 6 handle of yesteryear. So the idea as well that Chinese authorities might not need to see much further depreciation in the currency to begin with. Flip the board again. I wanted to talk you through as well what the implications might be for the rest of the region or other developing economies. Certainly, it's the idea that cheaper Chinese products could undercut that of competitors. And if you look at this chart, it shows you the correlation between what we're seeing in the Chinese currency and the emerging markets index as well. That's really shot up to the highest since June. Sherry.
Right, thanks, Avril. Let's bring back Charu Chanana, Chief Investment Strategist at Saxo. Charu, I mean, it surprises no one that if you continue to have these trade tensions with Washington, that Beijing might just allow the yuan to weaken. But that's not necessarily something that could work out well for them. What could be the implications of a yuan devaluation at this point when their economy is already under significant pressure?
I mean, you already talked about, Sherry, the risk of capital outflows where the economy is already facing, the markets are already facing tremendous pressure. One of the other things that I might highlight is that, the Chinese authorities have this significant focus on deleveraging at this point. And with a weaker yuan, even that path gets really tougher. The other aspect that I was looking at is, Chinese economy is actually facing really all signs of a balance sheet recession right now. They have a weak consumer confidence confidence. They have a weak business confidence. I think those are the first two things that they really need to address. There's been a wealth downturn for the consumers because of what's happening in the property prices, because of obviously the loss of wealth in the equity markets as well. So there's a lot of pressures, there for the Chinese consumer, and something like a depreciation of the yuan. Again, that kind of just makes it worse from that aspect as well, right? I mean, the rising prices of goods and services, and that could filter through to the consumer. It just weakens the consumer demand further, even though obviously China is in a deflation right now. How much further lower can you get from there? But I think what they really need to focus on is to understand how they can boost the consumer there. And when you talk about tariffs, really, we don't even know what exact measures we are going to get. So I think these are all negotiation tools used by Trump as well as now by the Chinese authorities as well. They're adopting the same measures.
And you mentioned all of these challenges on the Chinese economy, which you're already seeing in company earnings in China, right? We continue to talk about how cheap Chinese stocks are, but at the same time, it seems price gains might have outstripped earnings. What are you seeing?
I mean, I would really agree with the point that something that's cheap can continue to get cheaper, right? They are cheap for a reason, practically so. And all of these announcements that come through from the Chinese authorities, we've seen plenty of them in the last 3, 4, 5 months. We get this nice tactical rally, and that's purely because the valuations have been running so cheap. But they fizzle out very quickly as well, going back to the point that none of these measures have been really able to address the structural concerns of deflation, of, deleveraging that they want to achieve, of demographics that is being a big headwind for them as well. So none of these measures are really addressing any of those concerns. So as of now, I do think that whatever tactical rallies we get in the Chinese equity markets, for me, I remain on the side of selling those rallies because from a medium to long-term horizon, I don't see the positives coming through yet.
And we're seeing growth concerns over in India as well. Charu, we just heard from the new central bank governor there. Take a listen first.
Stability in policy, again, very, very important. And this is something, even in my previous role, we try to give a stability, a continuity in policy. So whether it is taxation policy or fiscal policy or monetary policy, I think all businesses, all people, they do need this continuity.
Are you getting any indications, Charu, from those comments, what the new RBI governor could be thinking in terms of easing next year?
I would say it's a little bit early to tell that, right? And given that I'm pretty sure even he's not made up his mind what he wants to do next. But having looked at, the growth trajectory, like you mentioned, there's some signs of a slowdown there. And then, of course, the disinflation trend is also providing some room to the RBI to start easing. I think there's been a little bit of a dovish tilt in the recent commentary as well. And we could probably see, some rate cuts coming through.
Are you expecting a rate cut from the Fed next week?
Absolutely. I think that looks very much priced in right at the moment, and it looks quite likely with the CPI print that we had yesterday. It was a little bit sticky, 0.3% month on month for the core for a fourth consecutive month. It does not really give a signal that inflation can go back down to the target that is 2%, but it does clear up the path for an immediate rate cut. Now, unless and until, you see something like a comment from WSJ's Nick Timirao saying that we're not ready to cut, I think the Fed looks set to cut next week. The bigger debate is really around what happens in 2025.
Right. Charu Chanana, it was really great talking to you. Thank you. Chief Investment Strategist at Saxo. And coming up next, LaSalle Investment Management shares their insight on Asia's commercial real estate sector. Hear why they're not expecting an end to China's property distress anytime soon. This is Bloomberg. Welcome back. You're watching Insight. Hong Kong's New World Development has reportedly sold an industrial building for $80 million as it offloads non-core assets to help address a liquidity crunch. The indebted developer has been facing pressure to manage its finances on top of recent leadership changes. Now, the next test could be its perpetual bonds with some $4.5 billion outstanding. Bloomberg Opinion columnist Shuli Ren joins us from Hong Kong. Shuli, so what's prompting these concerns? A New World may not call its perpetual notes or even pay coupons next year.
So the New World Development has seen some top leadership changes. Adrian Zheng, he left the New World late September, and since then there have been two new CEOs, and neither of them is from the Zheng family. So investors are getting worried that the founding family is going to let loose a New World Development a little bit. And also, like New World has been talking about using asset disposals to shore up their balance sheet, and it seems like selling assets is not so easy in Hong Kong. I mean, it's no secret that the commercial real estate is having a very severe downturn, and the few big transactions that we saw in recent months, they were basically sold at very, very deep discounts. So investors are getting worried that the New World, if they are getting cash strapped, they're going to treat those perpetual bonds like equity, basically not calling them and not paying coupons.
So, Shuli, does that mean that Hong Kong's developers could also become distressed? I mean, we saw that already with Chinese developers defaulting since 2021.
Well, I wouldn't go so far, and we hope not living in Hong Kong, because, it will be very bad for Hong Kong, the whole city as a financial center. But I wouldn't say that the Hong Kong developers are distressed, but they are definitely very high yield and very junk, basically. The only difference, though, is that we know the Chinese developers, they got really rich in the basically last 10, 15 years or so, whereas the Hong Kong developers, these families, they have been doing very well since the 1970s, right? So the question goes back down to whether the family is willing to come out and capitalize the developers. And that's the big unknown for global investors at this point.
And you mentioned Hong Kong as a financial center. Do you think this whole, the recent developments, if they get worse, that could actually threaten Hong Kong as attracting more capital, attracting more talent, which already it's been pretty challenged since COVID and even before that with the pro-democracy protests?
Yeah, I mean, Hong Kong retail sales is still 15% down from 2019 before the pro-democracy protests, right? And I do think, when New World issued those perpetual bonds, it was 2020, 2021. Global investors still thought, those names are very golden, right? Like people were willing to give them the benefit of a doubt. So if we see more volatility with the developer bonds, and if we see Hong Kong banks, including HSBC, stepping back from those commercial loans, I really think Hong Kong has an existential crisis coming up in the next year.
Shuli Ren in Hong Kong, our Bloomberg Opinion columnist. Now, for more on the real estate market, let's bring in Elysia, Head of Research and Strategy at LaSalle Investment Management. Elysia, good to have you with us. So Shuli just called this a potential existential crisis for Hong Kong. What do you make of the Hong Kong property market right now?
I would agree with that view. Hong Kong commercial real estate market remains very depressed, particularly with the backdrop of highly tied to mainland Chinese real estate demand. And also in selected sectors, we're also seeing oversupply. So demand and supply challenges combined, we believe it's a challenging environment for the next few years.
But it's all relative, right, when it comes to different markets? How does it compare to mainland China? Absolutely.
On a relative basis, mainland China will be even more depressed compared to Hong Kong, given the domestic consumer demand is at decades low. Economic growth is at decades low. There is lack of structural reforms and also larger stimulus packages to revitalize the economic environment. And adding on the top of the domestic challenges, the U.S. election results, it's also presenting potential more challenges going forward.
To be fair, we are seeing real estate stocks across China gain ground today, given, of course, a shift in tone coming from the Politburo, especially when it comes to property support. Will any of that stimulus make a difference?
Obviously, that will help to come off the lows, but whether how long it would take to get back to the healthy environments pre-pandemic, we believe it will take years. And until now, for investors who need immediate liquidity, they might still have to sell at a discount. But we believe that could be a good opportunity for domestic investors with long-term investment horizons to look for well-located real estate properties, particularly in multifamily or logistics at a deeply discounted prices right now.
Yeah, I mean, logistics has also been a sector that we've been watching very closely just because there was so much optimism around warehouses, not to mention, of course, data center build out. Could that be a saving grace for the Chinese markets, whether the mainland or Hong Kong?
Logistics sector certainly is expected to perform better than, for example, office or retail sector. But we want to look at sort of the supply-demand mechanisms. There are pockets of healthier supply-demand fundamentals, for example, in the Greater Bay Area. We remain cautious of the Greater Beijing area or pockets of the Greater Shanghai area where we see supply continue to outpacing demand.
When it comes to China, of course, it's also contending with potential geopolitical tensions, right? When it comes to those supply chain rebalancing moves that we've seen across Asia, what are some of the markets that could benefit?
Also, obviously, China and to some extent, Hong Kong will be the most vulnerable. Outside of these two markets, it's still too early to call the clear winners and losers. Just given there's still a lot of evolving pieces in terms of how President-elect will carry on his negotiation approaches. But on a relative basis, we believe Japan could fare relatively better in the greater regional context.
Why Japan?
Japan has been very proactively rejiggling the supply chain rebalancing. And for example, we see markets like Greater Fukuoka, where we're seeing greater reshoring of industrial production, especially the semiconductor industry. And that somewhat benefits the logistics sector in parts of Japan.
What do marginally higher interest rates in Japan by the BOJ mean for the broader property sector?
Obviously, higher interest rate is generally a negative for real estate, but we need to look at a more holistic approach. With higher interest rate, that's because the Bank of Japan is expecting inflationary growth. And for real estate sector, where our cash flows are highly tied to leases and tenants paying rent. So we see potential upside in terms of rental growth that could somewhat offset some of the interest rate impact. And in addition, if we look at domestic demand in the Japan real estate sector, for example, multifamily sector, we're seeing far exceeding inflationary rental growth right now. So to some extent, Japan is better positioned from that inflationary environment.
Yeah, also not to mention that when I say marginally higher interest rates in Japan, we're still talking around 0%, 1%, right? But what about the macroeconomic fundamentals leading to a cheaper Japanese yen? What does that mean for hotel properties and just the broader real estate market around tourism?
Yeah. Obviously, the cheap yen is helping not only the corporate profits, to some extent helps office tenants too, but when it comes to hotel sector, The weaker yen is keeping domestic travelers staying and traveling within Japan. And that weaker yen is also attracting cross-border travelers to Japan. So those two together, we're seeing fairly strong hotel momentum in Japan. And in addition, because there's a shortage of labor in Japan, for hotel operators who are able to leverage off their staffing capability and being more flexibly reallocating where resources and staffing resources needs, those could be areas of outperformance.
And Elysia, here in South Korea, of course, the property sector is always a hot issue, especially given that a lot of people have a hard time just affording houses. And this has become a huge risk also for the Bank of Korea. What are you seeing in the broader property market? I understand that commercial real estate is perhaps not as impacted as in other regions.
Yes, for example, office sector in Seoul, we're seeing vacancy rates that's below 1%, and partly that's driven by fairly strong corporate profits. Obviously, with a more complex political backdrop going forward, we're tempering our outlook for the rental growth, but the Seoul office sector remains one of the healthiest office market in the region and in the world.
Yeah, I've actually seen a lot of people in the office, so not a lot of issues with return to work after the pandemic, in fact, in Seoul. But what about other parts of Asia, like Singapore, for example? I mean, Shuli earlier talked about Hong Kong and it being a financial hub. How does Singapore really measure up to the rest of Asian economies when it comes to the property market?
So Singapore commercial real estate market has fared relatively resilient coming out of the pandemic and continue to be doing well. But we're seeing signs of the market peaking. Well, markets peaking doesn't mean it's going to come off right away, because we still believe that some of the real estate capitals who are diverging from mainland China and Hong Kong, Singapore could be the benefit of that, in particularly office sector. And in LaSalle, we favor freehold offices in strong locations where there's a scarcity value. We believe that performance will continue to remain resilient.
And Elysia, we went through many different markets across Asia, and it seems a lot of uncertainty as well as a lot of different dynamics. In this very complex environment, how do you expect real estate funds to do in 2025?
We're certainly operating and navigating in a more complex macro and geopolitical environment, but we believe that real estate investment funds who has local execution capability, local leasing capability will continue to outperform. In LaSalle, we focus on markets where we could leverage off domestic tenant demand, for example, Australian logistics. We favor markets and sectors where there's an anchor of domestic capital, for example, Japan real estate, and where we have local capability to do deal executions and local leasing capabilities. Those are the areas of focus for our investment strategies where we believe to be outperforming.
Elysia, it's really good to have you with us and your insights into broader property market across Asia. We're Asia Pacific Head of Research and Strategy at LaSalle Investment Management. And we're following the Chinese markets right now. We are seeing some retail stocks gaining ground and the CSI 300, in fact, rebounding to a one-month high. We're talking about these retailer stocks extending a rally. We had a report that says more cities are launching a new round of voucher programs to encourage local consumption before the holidays. Really not surprising, this report coming from the Economic Information Daily, that cities like Beijing, Changzhou, and Shanghai could start this new round of voucher issuance, given, of course, the faltering Chinese economy and how much policymakers have changed their tone when it comes to supporting the economy at a time when we could potentially see more geopolitical tensions with the U.S. We actually have the latest on that, because coming up, Donald Trump reportedly inviting Chinese President Xi Jinping to attend his inauguration next month. Details next. This is Bloomberg. Welcome back. Outgoing U.S. Treasury Secretary Janet Yellen says Donald Trump's plans for broad-based tariffs on China will hurt the U.S. economy and provoke retaliation from Beijing. She spoke to us exclusively in Washington.
Many countries, when they're faced with unilateral actions of that sort, look for ways to retaliate. And my guess would be that they would do that. We have in areas of concern where I've expressed repeatedly concerns with overcapacity that is developed in Chinese advanced manufacturing industries and clean energy, semiconductors, and the like. We think it reflects active, large subsidies that are flooding the world with exports and threaten to drive our firms out of business in areas that we think are critical to our own future. We've put in place tariffs. Now, they're strategic. They affected $18 billion worth of trade, certainly not all of our trade with China. And we did it to make sure that China's actions don't undermine our own plans to support these sectors. But broad-based tariffs, almost all economists agree that what they will do is hurt us by raising prices, possibly substantially, and making it more expensive for firms that need inputs from China to be able to acquire them, and harm our competitiveness of firms that rely on those imports. So we've taken a strategic approach, focusing narrowly, and a broad-based approach I have serious concerns with, as most economists do.
U.S. Treasury Secretary Janet Yellen speaking exclusively to Bloomberg. And even as Trump threatens tariffs against China, reports now suggesting that he's invited Chinese President Xi Jinping to attend his inauguration. Our chief North Asia correspondent, Stephen Engel, is joining us with the latest. But Steve, I mean, this would be really unprecedented if it were to happen.
Yeah. It would be a break from protocol for sure. It's very rare, if it is even has happened at all, for incoming administrations and incoming presidents to invite and have foreign leaders come to what is essentially a civil government ceremony, the inauguration of the president. Sure, celebrities come, past presidents come, donors come, and it's, a domestic U.S. affair. So it would be preposterous, right? Absolutely inconceivable to have Xi Jinping go to the steps of the Capitol for the inauguration on January 20th, right? Well, these two gentlemen are not too conventional, so it's plausible, but highly, highly unlikely. But it's kind of shows the unpredictability, that's the word I'm looking for, of Donald Trump. Because, again, on the one hand, he has the iron fist, and on the other hand, he has, of course, the velvet glove towards China, proposing sweeping tariffs across the board on Chinese products. He stacked his cabinet, at least with the nominees, of anti-China hawks, like Marco Rubio, as also Mike Waltz as national security advisor. And then on the other hand, he calls Xi Jinping one of his good friends and that he admires Xi Jinping. So now it's in your court, Xi Jinping, to respond to that RSVP.
I mean, I gotta say, Steve, nothing is inconceivable right now with President Trump, right? I do wonder even, remember when he actually met with North Korean leader Kim Jong-un? Is he trying that sort of really top-level diplomacy at this point? But Beijing is not just sitting idle. I mean, they are coming up with signals that they're not going to be taking this sitting down. What sort of signals in terms of tools that they could use in a trade war are they showing us right now?
Yeah, that's right. I mean, this is a completely different situation than, of course, Donald Trump trying to get those two different, and it's succeeding, having those two summits with Kim Jong-un in Vietnam as well as in Singapore back-to-back years. Obviously, Kim Jong-un needed that high-profile elevation on the world stage that Donald Trump gave him. Xi Jinping does not need that. But again, Xi Jinping also wants to kind of strike a balance with the incoming Trump administration. It's a very different domestic economy in China right now than it was in the first Trump administration. It's much weaker. So you can kind of feel that China is incentivized to strike some middle ground with the incoming Trump administration so as not to get too much blowback from those tariffs from China's retaliatory steps that they might take, too much blowback on the domestic economy to hurt the Chinese economy. Let's face it, China at this point does not, and probably at any point does not want decoupling with the United States. So they do have to manage this relationship. Again, I think these two gentlemen, while they'll be adversaries on trade, they might try to strike up a more cordial interpersonal relationship.
But at the same time, I kind of feel Beijing doesn't necessarily have to help the U.S. I mean, there have been reports that they might just allow the yuan to weaken. That might give them a competitive edge. And right now, why spend more money trying to defend that pressure on the yuan, given, of course, the Fed's policies as well?
Well, absolutely. But it's a double-edged sword as well. You weaken the yuan, as our competitors reported that China is considering weakening, allowing it to weaken to 7.5 to the U.S. dollar, almost parity to the Hong Kong dollar. That would have been unheard of a few years ago, and definitely during the first Trump administration when it was in the six-handle range. But again, the double-edged sword to that is, yes, it gives the exporters a boost in China, cheaper products and more competitive on the global stage. But at the same time, if you weaken it too far, you're going to get those dreaded outflows or the threat of dreaded outflows. And again, that is not something Xi Jinping wants right now, and they want to attract foreign capital to China. So that could basically undermine. Also, it increases the import bill for China as it tries to boost domestic consumption. So that's why you saw overnight basic metal prices drop because, again, their import bill would go up. China's import bill would go up. So they have to. That's why that PBOC linked newspaper column was key. They basically are channeling the communication to say we want a stable renminbi, even though it has been steadily weakening, and that's to be expected given the strong dollar and also the moderately loose monetary policy that they've basically dictated for 2025. They just don't want too much depreciation.
Just super quickly, Steve, we have like 30 seconds. Economic policies, what can we expect in 2025?
More proactive fiscal policies is what everybody's wanting, and that's hopefully, those who are actively participating in the Chinese market would get to help boost domestic consumption. I think it's going to be a domestic consumption story in 2025 in China.
You're the best, Stephen Engel, there with a super short answer on what to expect on the Chinese economy for the entire 2025. And before we go, here's a look at our guests for tomorrow. We'll check in on India's automotive sector with the CEO of Mahindra Auto and farm sectors, plus MasterCard's chief Asia-Pacific economist as well. That's it for Insight. Horizons Middle East and Africa is next. This is Bloomberg.